5:50 a.m., March 19th, 2026, Carson, California. 140 federal agents moved simultaneously across 11 separate addresses in the Los Angeles Industrial Corridor. Estimated value of the financial network they were dismantling, $217 million. At 1847 Avalon Boulevard, a six-vehicle convoy of unmarked SUVs cut its headlights as it turned into the parking lot of a low-profile office suite. The building sign read Pacifica Freight Consulting Group. It looked like any other cargo compliance firm in a corridor full of them. Beige stucco, tinted windows, a small loading dock that hadn't been used in months. The agents stacked outside the main entrance in silence, breath visible in the cold morning air, body armor cinched, radios on earpiece-only mode. At exactly 5:50, the warrant was served. The door opened under a ram within 4 seconds. 11 locations, one simultaneous federal warrant package, 9 banks frozen within the same 60-second window. The Iranian sanctions evasion operation hidden inside those office suites had been running since November 2025. It had moved $217 million through the U.S. financial system without triggering a single automatic flag. It had done so by hiding inside the most boring infrastructure imaginable, freight audit paperwork. That was the point. The scheme's architects understood something most financial criminals miss. The best camouflage isn't a shell company in the Cayman Islands. It's a licensed, certified, DoD-registered business that processes tens of thousands of routine invoices per month. Something so tedious that no analyst wants to look at it twice. For 16 months, they were right. Then one OFAC analyst in Washington looked at it 3 times. The United States naval blockade of Iranian export ports began in October 2025. It wasn't announced with fanfare. The policy framing was quiet. A series of Treasury Department designations paired with coordinated naval positioning in the Strait of Hormuz and the Gulf of Oman. But the effect was immediate. Iranian crude oil, which had been moving through a network of shadow tankers and flag of convenience vessels, suddenly had nowhere to go. Export revenues that Tehran had been quietly routing through layered intermediaries in the Gulf dried up almost overnight. For the Iranian financial architecture that depended on those revenues, October 2025 was a crisis point. Someone had to find a new pipe. What they built in response was a careful piece of institutional mimicry. 11 freight audit and cargo compliance consultancies incorporated across a 14-month window between September 2024 and November 2025, each holding valid customs trade partnership against terrorism certifications, CTPE, and active Department of Defense vendor registrations. Their stated business model was straightforward: auditing shipping invoices for Fortune 500 importers, catching billing errors on commercial freight, recovering overcharges from carriers. It was a real industry. It generated real fees. The firms had real clients, real employees, real lease agreements on real office space in Carson and Torrance. The revenues from legitimate audit work ran into the millions annually. That wasn't cover. It was structural camouflage. The firms had to be real businesses because the entire scheme depended on them being indistinguishable from real businesses. The mastermind behind those 11 entities, a logistics consultant named Dariush Mahmoudi, operating out of a registered office in Dubai, had spent 18 months building something that would survive a surface-level compliance audit. He understood the freight audit industry because he had worked in it. He knew that swift correction notices, invoice reversals, and audit fee adjustments were processed in enormous volume by major banks, that the dollar amounts were often large, and that the underlying documentation was almost never reviewed by a human being. It was processed automatically, flagged only if it crossed specific threshold triggers, and filed. The scheme worked as follows. Iranian crude oil revenue, generated through shadow fleet tanker sales off the coast of Oman and through intermediaries in the UAE, entered the U.S. financial system as what appeared to be audit fee reversals. A shell entity in Dubai or Muscat would file a swift correction notice against a legitimate commercial invoice, routing the correction payment to one of the 11 LA firms as a reimbursement for a fabricated billing dispute. The LA firm would receive the funds, process them as revenue, and within a standard accounting cycle, wire the net amount to accounts in Singapore and Hong Kong, described in internal documentation as correspondent audit partners. Each transaction, viewed in isolation, looked like routine freight finance. The amounts were large, but not anomalous. Freight audit reversals regularly run into 6 figures. The counterparties were Gulf-based entities with legitimate commercial histories. The receiving accounts in Asia were registered financial services firms, not obvious shells. The scheme moved $217 million in 16 months without a single automatic alert. What no one expected was that it would be spotted not by an algorithm, but by a pattern. The OFAC analyst who noticed it first was a mid-level examiner named Andrea Castillo, assigned to the Iran sanctions desk in the Treasury Department's Washington headquarters. In late January 2026, Castillo was conducting a routine review of SWIFT correction notices filed by US-based freight entities against a list of commercial tanker routes that OFAC's intelligence desk had flagged as suspected Iranian shadow fleet corridors. The review was supposed to take 2 hours. It took 3 days. What she found was this: 14 specific commercial tanker routes, all of them on OFAC's shadow fleet watch list, had generated an unusually high volume of SWIFT correction notices over the previous 4 months. That alone wasn't alarming. Shipping invoices on contested routes often generate disputes. But when Castillo cross-referenced the entities filing those notices, she found something that shouldn't have been there. 11 different Los Angeles-based freight audit firms had all filed correction notices on the same 14 routes. Not similar routes, the same 14. The probability of 11 separate independent firms all selecting the same 14 obscure contested routes as their primary audit targets was, in Castillo's words in her initial memo, statistically incoherent. She flagged it at 4:47 p.m. on January 29, 2026. She pulled one thread. I spent time going through the original case file. One detail kept nagging me. Castillo's initial memo was 3 pages. The footnote on page 2 mentioned that she had almost dismissed the overlap as a routing coincidence before running the probability calculation manually. If she had closed the file an hour earlier, the network might have run for another year. Within 6 hours of Castillo's flag, the OFAC Iran desk had escalated to the Financial Crimes Enforcement Network and placed a data preservation hold on SWIFT records connected to all 11 firms. Within 48 hours, a joint OFAC FBI task force had been formally constituted under a sealed case designation. The lead FBI agent assigned to the case was Special Agent Thomas Wren, out of the Los Angeles Field Office's Financial Crimes Unit. Wren had spent 11 years working trade-based money laundering cases. He had never seen a sanctions evasion architecture built this methodically. Here's the thing. This network wasn't designed to run indefinitely. No scheme moving this volume through US. Correspondent bank stays invisible forever. But the architects had apparently planned for a finite operational window. Get the Iranian revenues into the clean financial system, route them to Asia, close the pipeline before anyone looks. They had estimated, based on the architecture Wren's team later reconstructed, that they had approximately 18 to 24 months before the pattern became visible. They had 16. The investigative phase that followed the initial flag was 6 weeks of intensive forensic work. Wren's team subpoenaed SWIFT records, correspondent bank transaction logs, CTPAT certification files, and DoD vendor registration documentation for all 11 firms. What emerged was a layered picture of financial engineering built with genuine sophistication. Each of the 11 firms had a distinct operational profile. They served different client rosters. They used different banks. Their internal accounting structures were different. Taken individually, each firm looked like an independent business. Taken together, when mapped against the 14 flagged tanker routes, they formed a coordinated network, what Wren's team internally called a distributed pipe. No single firm was moving enough volume to trigger automatic scrutiny. Collectively, they were moving $217 million. The firm's SWIFT correction notices were the intake mechanism. But what Wren's team found in the outbound wire records was the real architecture. The funds leaving the 11 LA firms weren't going directly to Iranian-connected accounts. That would have been too visible. They were routed first to a set of correspondent accounts at a bank in Singapore, where they were pooled and refragmented, then distributed to accounts in Hong Kong under descriptions that referenced audit partnership fee distributions. The Singapore intermediary was a licensed financial services firm, legitimate, regulated, and apparently unaware that it was being used as a pass-through. That was the working assumption until week 4 of the investigation. In week 4, Wren's team pulled the Singapore entity's correspondence records. There were 47 emails between the Singapore firm's compliance officer and an encrypted address that, when decoded, traced back to a server in Oman. The compliance officer, it turned out, was not unaware. That was the first indication that the network was larger than the 11 LA firms. The second indication came from the physical evidence recovered during the February surveillance phase. Beginning February 9th, 2026, FBI surveillance teams established static observation posts near 4 of the 11 firms, with rotating mobile surveillance on the remaining 7. Over 12 days, they documented behavior that was inconsistent with a normal freight audit operation. Courier document deliveries arriving after business hours, a recurring pattern of all 11 firms receiving external visitors from the same 2-vehicle set of rental cars registered to a logistics consulting entity in Torrance, and, most significantly, a weekly cash withdrawal pattern at 3 of the firms totaling between $180,000 and $240,000 per week, withdrawn in increments just below the currency transaction report threshold. The surveillance teams logged 847 individual observations across those 12 days. Agents photographed license plates, tracked entry and exit times, and documented which couriers visited which firms and in what sequence. The couriers never used the same vehicle twice. The rental registrations rotated through a set of names the task force later identified as nominees. Individuals paid a flat fee to put their names on car rental agreements and ask no further questions. A pattern emerged that was invisible at any single location, but unmistakable across all 11. The firms operated on a synchronized weekly cycle. Mondays were for swift notice preparation. Wednesdays were for cash withdrawals. Fridays were for outbound wire processing. The same rhythm, every week, across every firm, for 16 months. Whoever designed that operational cadence had thought carefully about compartmentalization. Each firm's employees saw only their own piece of the cycle. None of them, presumably, saw the map. The cash withdrawals were the tell. Legitimate freight audit firms don't pay operational expenses in cash. There's no reason to. The withdrawals indicated that some portion of the incoming funds was being converted to physical currency, likely for expenses that couldn't appear in any financial record. Wren requested a pen register and trap and trace order on the phone lines associated with all 11 firms on February 14th. The order was granted the same day. What the intercepts revealed over the following week confirmed the architecture Wren had already mapped from the financial records. The 11 firms were in regular communication with each other, not through public channels, but through a shared, encrypted messaging application whose server logs Wren's team obtained through a mutual legal assistance request to the UAE on February 21st. Those logs included references to a figure identified only as the coordinator, whose instructions to the 11 firms covered transaction timing, swift notice formatting, and cash management protocols. The coordinator's communications originated from Dubai. Here's what this case tells us about how sanctions enforcement actually works. The blockade of Iranian exports didn't stop the money from moving. It changed the pipe. Every time a conventional channel gets shut down, a more sophisticated replacement gets built. The architects of this network weren't amateurs. They were financial engineers who understood compliance infrastructure well enough to build inside its blind spots. That's not a story about Iranian sanctions specifically. It's a story about the gap between the speed of regulatory innovation and the speed of criminal innovation. The gap is usually about 18 months. By early March 2026, Wren's team had enough. They had mapped the full financial architecture. They had identified 3 of the 11 firms' principal operators as the on-site decision-makers for the network. Cyrus Tehrani, listed as Managing Director of Pacifica Freight Consulting Group, Omar Nasseri, listed as Principal of Continental Cargo Audit Partners, and Layla Rostami, Operations Director of Pacific Basin Freight Services. They had identified Dariush Mahmoudi in Dubai as the coordinator and had obtained an Interpol Red Notice pre-authorization for 2 additional principals identified in the UAE server logs, but whose physical locations remained outside U.S. jurisdiction. They had also identified the master document that held the entire network together. One detail that stuck with me, going through the indictment, the master spreadsheet. Described in the warrant application as a 47-column, 300-row document maintained on an encrypted server partition accessible only through the firm's shared messaging application. It mapped every Iranian Shadow Fleet tanker route the network had serviced since November 2025. Route identifiers, vessel aliases, cargo volume, corresponding SWIFT notice numbers, incoming amounts, outgoing wire references, and cash extraction totals. Wren's team knew the spreadsheet existed from references in the intercepted messages. They didn't know what it contained until they physically recovered it on March 19th. When they opened it, the investigator who pulled it described it in a subsequent court filing as a complete operational ledger of the Iranian crude revenue pipeline, cross-referenced to every transaction the network had processed. That document alone was the difference between a financial crimes case and a national security case. The warrant package for the March 19th operation was sealed by a federal magistrate in the Central District of California on March 17th. It authorized simultaneous searches of all 11 firm locations, the personal residences of Tehrani, Nasseri, and Rostami, and 4 storage units linked to the cash withdrawal pattern. It also authorized simultaneous asset freezes at 9 banks, covering every account connected to the 11 firms and their identified shell counterparties. 140 agents were assigned to the operation. The FBI contributed 86 agents from the Los Angeles field office and a specialized financial crimes response team flown in from Washington. OFAC contributed 6 on-site monitors, whose role was to ensure that any digital financial infrastructure encountered during the searches was immediately flagged and preserved. The IRS Criminal Investigation Division assigned 12 agents to handle the cash recovery and accounting. Homeland Security Investigations contributed the remaining 36, primarily for perimeter and logistics. Here's an unpopular take. The 3 principals arrested on March 19th are facing sentences in a case where the real architects are sitting in Dubai. Tehrani, Nasseri, and Rostami ran the operational layer of a network designed and directed from outside U.S. jurisdiction. The Interpol red notices for Mahmoudi and a second Dubai-based principal, identified in court documents only as MA, may never produce extradition. The people who built the pipe are almost certainly beyond the reach of what got dismantled on March 19th. The operation began at 5:50 a.m. on the dot across all 11 locations. The coordination had been rehearsed twice in the week prior, using building schematics obtained from Los Angeles County records and, in 3 cases, from additional surveillance conducted by undercover agents posing as commercial real estate brokers who toured the office spaces under a cover story about evaluating comparable properties for a client. Those agents had walked the floor plans. They knew which interior doors opened inward, where the server infrastructure was likely positioned, and which exit routes employees might use. Nothing was left to improvisation. At Pacifica Freight Consulting Group on Avalon Boulevard, Wren was on site. He watched the door come in and entered the building with the second element. The main office was a standard open-plan layout. 6 workstations, 2 private offices at the rear, a server rack behind a locked interior door. The workstations were tidy, organized. The kind of deliberate orderliness that comes not from office pride, but from a protocol, minimizing what could be seen at a glance by anyone who wasn't supposed to be there. Tehrani was found at his desk. He had been there all night, processing a batch of swift correction notices scheduled to file that morning. A half-empty coffee cup sat next to his keyboard, a notepad with handwritten wire reference numbers. A second monitor displayed what appeared to be a live currency conversion feed, dollars to Singapore dollars, refreshing in real time. He looked up when the agents came through the door and did not move. He said nothing. He was arrested without resistance, his hands already on the desk surface when the agents reached him, as if some part of him had spent 16 months rehearsing exactly this moment. The server room took 11 minutes to access. The interior door had a secondary electronic lock that wasn't on the building plans. The FBI's technical support team had a bypass kit that handled the lock on the 3rd attempt. Behind the locked door were 2 rack-mount servers and a networked storage array. The servers were running. Active processes. Whatever Tehrani had been working on through the night was still open, still executing, when the agents entered the room. One of the OFAC monitors on site immediately photographed the active screens before anything was touched. Total data recovered from that single location, 3 terabytes. At Continental Cargo, audit partners on West Sepulveda Boulevard in Torrance, the entry was more complicated. The building had a shared lobby with 2 other tenants, and the warrant was limited to the 3rd floor. The lobby security guard, who was not a subject of the investigation, had to be escorted from the premises before entry could proceed. This delayed the initial breach by 4 minutes, within the acceptable operational window, but enough to require radio confirmation from the operations center that the asset freeze orders at the associated bank accounts had already executed. They had. Nasseri was not in the office. A subsequent check of his registered home address confirmed he had been there. His vehicle was in the driveway, and he was placed under arrest at his residence by a separate element at 6:02 a.m. Rostami was at Pacific Basin Freight Services, a 2nd-floor suite in a mixed-use building on Figueroa Street in Carson. She was in a conference room with 2 employees who were not subjects of the investigation. The employees were separated and interviewed on site. Both said they had believed they were working for a legitimate freight audit consultancy. Both described their daily work as reviewing shipping invoices and preparing correction notices, which was, technically, accurate. Rostami invoked her right to counsel immediately and said nothing further. Her laptop, open on the conference table, was seized and imaged. It contained, among other items, the local cache of the shared messaging application, including message history going back to October 2025. What do you think? Did the firm's employees who weren't arrested know what they were part of? The indictment is silent on that question. The investigation isn't closed. Across all 11 locations, the search operation ran through the afternoon. In total, agents recovered 34 terabytes of digital evidence, falsified audit records, SWIFT notice templates, encrypted financial logs, and the master spreadsheet. They also recovered $11, $2 million in undeclared cash from 4 safes spread across 3 of the firm locations, $4. $7 million in a floor safe at Continental Cargo Audit Partners, $3. $9 million in a wall safe behind a filing cabinet at a 5th firm called Western Pacific Trade Audit, and $2. $6 million in a dual lock safe recovered from a storage unit in Compton linked to the cash withdrawal pattern. The cash was bundled in consistent denomination stacks, wrapped and sealed, staged for movement, not in active operational use. Wren's team concluded that the $11, $2 million represented the most recent cycle of cash extraction from the network, funds converted from wire transfers and waiting for a courier who never arrived. 2 of the firms, the 9th and 11th on the warrant list, yielded almost nothing. The offices had been recently cleared. Not moved out, but cleared. Hard drives removed from workstations, paper files absent, filing cabinets empty. The leases on both spaces were still active. The clearing had occurred within the previous 72 hours based on surveillance footage from the building's lobby cameras. Someone had received a warning. Wren's team had operated under strict communication security throughout the investigation. The leak, if it was one, didn't come from inside the task force. The working theory, based on the timing and on message fragments recovered from Rostami's laptop, was that Mahmoudi in Dubai had directed the clearing of those 2 locations after detecting what he believed might be surveillance on one of the firms in the days before March 19th. He had been partially right. He had cleared the wrong 2. Will operations like this be dismantled faster in the next 5 years as OFAC develops better automated screening for swift correction notice patterns? Comment yes or no. Because the honest answer from everyone Wren's team consulted after the case closed was maybe. And maybe isn't a deterrent. By the end of March 19th, the 11 locations had been processed. Tehrani, Nasseri, and Rostami were in federal custody. The 9-bank asset freeze had locked approximately $47 million in accounts, a fraction of the $217 million the network had moved, but the portion that remained in the U.S. financial system at the time of the operation. The rest had already cleared into the Singapore and Hong Kong accounts, where international asset recovery proceedings were initiated, but faced the standard complications of multi-jurisdiction financial crime. Slow treaty processes, local legal challenges, and accounts that had been partially moved within hours of the March 19th operation becoming visible in financial surveillance systems. Mahmoudi and MA remain in Dubai. The UAE has received the Interpol red notices. As of the last available court filing, no extradition proceedings have been initiated. The $217 million is not fully accounted for. The $47 million in frozen accounts, the $11. $2 million in physical cash, and approximately $31 million in traceable outbound transfers subject to ongoing international recovery proceedings account for roughly $89 million. The remainder, more than $120 million, has passed through the Singapore and Hong Kong intermediary accounts and into a distribution architecture that investigators are still mapping. Tehrani entered a guilty plea in May 2026 to 1 count of conspiracy to violate the International Emergency Economic Powers Act and 1 count of money laundering conspiracy. Sentencing is scheduled for September. Nasseri is contesting charges. Rostami's case is pending. The court record also contains a sealed attachment. Its existence disclosed, but its contents classified. That the government has described only as relating to intelligence information developed during the investigation. What that attachment contains, what it implicates beyond the 11 firms, and whether it points to additional network nodes that weren't addressed in the March 19th operation are questions the public case record doesn't answer. If you've followed sanctions evasion cases before, you know this pattern. Something got dismantled in March 2026 in Carson and Torrance. Something replaced it before the warrants were even executed. The Iranian financial infrastructure didn't depend on these 11 firms. It used them. When they became unavailable, the coordinator in Dubai had already been building the next pipe. The ledger in that master spreadsheet documented 2,300 rows of transactions. The network had been operational for 16 months. The blockade of Iranian export ports that created the need for this network is still in effect. The 11 firms are closed. The cash is in federal custody. 2 men who built the architecture are in Dubai, and the tanker routes on OFAC's Shadow Fleet watch list are still moving.